Hi everyone, it's Stephen here. In this video, I'm going to be explaining 4 important calculations that you should be using when analysing a buy-to-let property investment deal. These are yield, asset pricing, net operating income, and cash-on-cash return. And I'm going to show you an example for each of them and also explain why you'd want to use them. First things first, my focus when I'm using each of these calculations is to make sure that the property I'm looking at is positive cash flow. This means that the income is greater than all the expenses I have to pay for that property. So first up, we have yield. To work out the yield of a buy-to-let property, we take the annual rental income, divide that by the value of the property, then we times that by 100 to get this as a percentage, and that gives us our yield. I'm using the value of the property, but you can also use the purchase price. The reason being that the value of the property allows for change over time. So as an example of this calculation, let's say that we've got an annual rental income of £20,000. We divide that by our purchase price of £200,000. That would eke us a 10% yield. So why we'd want to use this formula is because we're going to use this formula as a basis of a comparison between different properties. It allows us to compare properties based on their yield amount, and we're looking to get the highest yield possible when we're looking at a buy-to-let property investment. The higher this number, the better. So if you want a certain yield from a buy-to-let investment, you can use this calculation to determine the property price or the asset price. So we have annual rent divided by the yield equals the offer price. So as an example here, we would say we've got £12,000 in annual rent. We want to be making a 9% yield. So we make that as a decimal point, divided by 0.09. That will then equal our max offer price of £133,333. The key thing to note here is that our yield is determining our offer price. So with asset pricing, I'll be using this one to work out how much I'd want to make an offer on a property based on the target yield that I'm looking to make, or to value a property that I already own based on how much income it's generating, or if I wanted to sell this property to an investor and I was offering this property at a certain yield amount. So if I was saying it was going to be a 7% yield or an 8% yield, what would the price be? So if we were to say we'll value this property based on 8% yield, that would increase the value of this property to £150,000. Because what we're doing here is we're lowering the yield, which therefore increases the price, the value of that property. So let's now look at net operating income. This allows us to determine how much cash flow a buy-to-let property is actually making. The calculation for this is, it's the operating income minus the operating expenses. So operating expenses would be things like insurance, maintenance and repairs, and the property management. It doesn't include the finance costs or any accounting costs in this calculation. So an example would be, you've got an income of £13,000. You take that away from your operating expenses for that property, say that's £3,000. That will then leave you with £10,000 NOI. So with this one, it provides us a basis for comparison again between properties. We're able to then look at different properties and work out what is the net operating income, the actual cash flow that each of the properties is going to make for us to determine which one's a better investment. And always remember the terms. Gross is what you make and net is what you actually take home. So this is what you're taking home before any finance costs such as mortgage or any accountancy fees. Then we've got cash on cash return. So the next calculation is our cash on cash return or return on investment. So this calculation is we take our annual cash flow, we divide that number by our cash down. We times that by 100 to get that as a percentage. So this figure includes our mortgage numbers and accounting costs. So as an example here then, we would say we've got £5,000 and we divide that by our cash down. Let's say we put £30,000 down. We times that by 100 to get our percentage. That would then equal a 16% cash on cash return. This is the ultimate calculation that you want to be using as a deeper dive if your property's passed the other calculations. And this is going to actually tell you how much money you're making based on your cash outlay and how much cash you're going to get back after all expenses, after all the costs and mortgages and all of those types of things. This is how much money you're getting back in your pocket expressed as a percentage. And obviously what we're trying to do here is we want to make this as high as possible. You should always use this one when doing a deeper dive on a buy-to-let investment property. You don't need to use all of these calculations for every property that you look at. Start with yield and then a net operating income, and then if those two stack up, look at cash on cash return. If you enjoyed this, I've recently done a video on how to grow your buy-to-let portfolio from 0 to 10 properties in 3 years, starting with just £30,000, and I'm going to link to that one just here. If you want to learn more about a commercial buy-to-let investment property that I bought recently, I've done a video about that one and I'll link to that one just over here. Thanks so much for watching. I really do appreciate it, and I'll see you next time.